Hello and welcome back to the Geordie Pig Investor channel. Today we are going to look through the 5 best US ETFs on the market right now. We're going to start off by having a look through and explaining what an ETF is. An exchange traded fund, ETF, is a collection of investments such as stocks, bonds or commodities that are packaged together into one fund. This is then available to buy or sell on the stock exchange just like individual stocks. An ETF is very similar to a mutual fund, but they do have some differences. I'll get onto those a little bit later on. ETFs are a simple way to access investment markets and diversify your portfolio without the stress and thinking process you have to go through when trying to select individual stocks. When you buy an ETF, you're buying a portion of a fund's underlying portfolio. Most ETFs track an index. This is a group of securities that represent a specific sector or region. An example is the FTSE 100, which is an index that tracks the 100 largest companies in the UK. Who should include ETFs in their investment portfolio? ETFs can be a great investment for all long-term investors. Specifically, they're a really good option for beginner investors because they won't require time, effort and the experience needed to research individual stocks. It may also be cheaper to own an ETF rather than buying a diversified selection of individual stocks due to the fees that come with buying individual stocks. When you buy and sell, you have to pay FX fees, whereas when you buy an ETF, there is usually a fee on the ETF, but it's just a one-off fee, and normally for an ETF, you would just be keeping a hold of it then, especially if you're a long-term investor. ETFs are also cheaper to own than mutual funds, and you can trade an ETF throughout all exchange hours, unlike a mutual fund that can only be traded once per day. This means that ETFs give you more flexibility, which certain investors may prefer. What's the biggest risk to owning an ETF? Just like any investment, an ETF's greatest risk to an investor is being in the market. If the underlying index that an ETF tracks drops in value due to unfavorable market price movements, then your ETF will also drop in price. However, the likelihood is that if you are invested in a good, reliable ETF as a long-term investor, then you'll be able to ride out these waves and come good long-term. Past performance is not a guarantee for future results as to the returns that you may receive from a particular ETF. And that's what we're going to look into today. As well as this, remember that owning individual stocks usually carry a higher risk than something like an ETF. The first ETF we're going to look at today is going to be the iShares Core S&P 500 ETF, ticker symbol IUSA. The iShares Core S&P 500 ETF is an exchange-traded fund that seeks to track the S&P 500 index, which is based on the largest 500 US companies by market capitalization. Their current price is £42.48. They launched in 2002, so they've been around for over 20 years, have a very, very cheap expense ratio, currently at 0.07%. They do have a dividend yield at 1.1% and they pay that out quarterly. And they have a massive fund size at over 13,544 million. The top 3 sectors within this ETF are industrial at 30%, technology weighing in at 24.3%, and financial weighing in at 14.8%. So you can see nearly 55% of the portfolio is split between the top 2 sectors. The top 3 holdings within the portfolio, no surprise probably to see Apple up there at number 1 at 6.9%, Microsoft closely behind at 6.7% in this ETF, and Nvidia just behind there at 6.5%. The 1-year returns within the iShares Core S&P 500 ETF are 22.6%, 3-year return at 45.2%, and a 5-year return at 100.3%. And over the last months, as we can see on the graph, it has performed plus 6.21%. The next ETF we're going to look into is going to be one that pays a slightly higher dividend, and that is the WisdomTree US Equity Income ETF, ticker symbol DHS. This ETF tracks US stocks with high dividend yields via the WisdomTree US Equality Income Index. The index is a fundamentally weighted index and holds over 330 stocks within the ETF. Their current price is £18.58. And they launched a little bit more recently in 2014, but have still been around now for 8 years. They have a total expense ratio, which is quite considerably higher than the first ETF, but still on the lower side at 0.29%. They do have a much bigger yield at 3.22%, and they do also pay out quarterly. Although they do have a lot smaller fund size, being only 61 million, so that is something to consider. Their top 3 sectors are financial at 22.8%, industrial at 19.5%, and energy at 12.9%. With their top 3 holdings being AbbVie at 5.9%, International Machine Corp at 5.3%, and ExxonMobil Corp at 5.3% also. Their 1-year returns were 7.4%, 3-year returns being at 26.6%, and their 5-year return being 38%. So you can see overall their returns are quite considerably lower than the first ETF, but you are getting a much higher yield from this ETF, and I know that certain investors do prefer a higher yield. Over the last 6 months, however, this stock has performed very well, being up over 5.5%, and with those dividend payments included, this stock is actually one of the best performers out of all the ones I'll show you today over the last 6 months. The third ETF that I'm going to show you is also another WisdomTree one, and this is the US Quality Dividend Growth Stock, ticker symbol DGRP. This ETF tracks the WisdomTree US Quality Growth Index, which is tracking dividend-paying US stocks with growth characteristics. This index is fundamentally weighted and it tracks roughly 300 companies. Their current price is £31.45 and their fund launched in 2016. They also have a slightly higher expense ratio at 0.33% and their dividend yield is 1.19%. You may think it would be higher with it being a dividend growth focused ETF. However, with it being focusing on quality growth dividend paying stocks, this means that the stocks within this ETF are a lot lower yielding and have good dividend growth. So if that's something that you're more interested in, this could be the stock for you. Their fund size is 468 million, so a lot larger than the last one, but still not massive. And their top 3 sectors are industrial at 32.6%, technology at 20.1%, and financial at 15.8%. Their top 3 holdings, you can see Microsoft again there at 7.3%. Also Apple is in there at 5.5%, and AbbVie at 3.8%. Their total returns over the last year have been 18.4%. Over the last 3 years, 47.7%, and over the last 5 years being a big 92.8%. Over the last 6 months, this stock has also performed very well, being up over 5.4%. But as of right now, for me, the first ETF I showed you had the lowest expense ratio so far, had the best 5-year returns, and to be honest, that is what I'm mainly concerned about. Let's get on to the fourth ETF and see if it looks any better. The next ETF we're looking at is the UBS Factor MSCI USA Quality ETF, ticker symbol UC99. This has actually only just been added recently onto the stock market for UK buyers at the start of this year, but we can still see the performance over the last few years because it had been available to America at the time. This ETF aims to replicate the performance of the MSCI USA Quality ESG Low Carbon Select Index, offering exposure to companies in US large and mid-cap stocks consisting of 104 holdings. Their current price is £39.81. The fund launched back in 2015, has an expense ratio at 0.25%, so sort of in between from all the ETFs we've looked at so far. Has one of the lower yields at only 0.76% and has a dividend frequency semi-annually rather than quarterly. Their fund size is very big at being 1,354 million, and their top 3 sectors are industrial at 42.4%, technology at 26.9%, and healthcare coming in at 8.5%. We can see that this is the stock which has the biggest weighting within the top 2 sectors in the ETF, being at over 68% in this one. Their top 3 holdings include Apple at 8.9%, Nvidia at 8.3%, and Microsoft at 8.2%. Their 1-year returns are 26.6%, 3-year returns being at 50.8%, and their 5-year returns being a massive 117.2%. So as of right now, this is the best performer out of the current 4 ETFs that I have shown today. Over the last 6 months, this ETF has performed very well, being up 5.1%, and is this one that you may be considering to add into your portfolio. Finally, we've got the Fidelity US Quality Income ETF, ticker symbol FUSI, and this ETF aims to replicate the performance of the Fidelity US Quality Income Index, offering exposure to US high-quality companies which offer higher dividend yields. Their current share price is £8.12, and their fund also launched in 2015. They do also have an expense ratio at 0.25%, but their dividend yield is 1.83% and it is paid quarterly. They also have a fairly big fund size, being 1,188 million, and their top 3 sectors include industrial at 30.9%, technology at 20.3%, and then a massive drop down to financial at just 3.5%. We can see their top 3 holdings are Apple at 7.1%, Microsoft at 7%, and Nvidia at 6.7%. Over the last year, FUSI has returned 17.4%, over the last 3 years returning 41.1%, and over the last 5 years returning 84.4%. Over the last 6 months, this ETF has actually performed the best out of all 5 ETFs that I've shown today, being up 5.8%. However, every single one of these has interestingly been up over 5% over the last 6 months. This highlights that quite a few of the stocks are similar within these ETFs, but you do obviously get different returns from them. Do you currently own any of the different ETFs that I have shown today? Or is any of these different ETFs that I've shown potentially a position you might want to open up in your portfolio? What are you after? Is it more dividend yield or is it more capital gains? Let me know in the comment section down below. I hope you enjoyed today's video. Please let me know of any other videos you want to see in the future. If you like seeing these ETF breakdown videos, if you prefer the stock analysis, and if you like to see the portfolio videos. Thanks for watching. Don't forget to like and subscribe. And this is the Geordie Pig Investor, over and out.